I know that this is a trading channel, but today I'm going to talk to you about the psychology behind investing strategies. Why you need to invest in the markets. Hey, it's Coffee with Rob. Let's have some coffee. So good. And then come into the office with me and let's have a look at the best way that you can invest so that one day you can have loads and loads and loads of money falling out the sky like everyone shows you. Look, at the end of the day, there is one thing you have to understand. While we're traders and we trade price action and we trade all these wonderful systems and strategies, there is one thing in the market that can make you a lot of money over time. And we have a saying in the market, and it's called time in the market, not timing the market. And that is what we do as traders is we try to time the market. We try to time a trade. We try to pick up a trade at exactly the right spot, and we try to make money off it. But if you have an investment account, that's a completely different ballgame. It's much, much more profitable in the long run. But you have to have patience. You have to have 10, 20, 30 years. And I'm going to take you and I'm going to show you the calculator that's going to make you that money over time. Let's go and have a look at the calculator, and then let's carry on talking a little bit about the strategy behind making money. So remember, guys, there are risks with the stock market, even if you're investment. So do understand that these risks do exist, and you should be wary. And if you don't like losing money, you definitely shouldn't be trading. But I do believe that investing is a lot safer. At the end of the day, if you're investing, you should be okay, because it's set and forget. 9 times out of 10, you'll be okay. But you do get those moments when, you see the market crashing and then you sell out of your investments and you go, oh my goodness. And of course, you make a loss and then it all goes back up. So my recommendation when investing is never, ever sell your shares. Just keep them forever. So I'm just going to show you on this investment calculator what the scenario is. And at the moment, I'm just going to take a 10% return rate, which is what you would get at the bank. So let's say you put your money in the bank at 10% annually, and you put an additional $1,000 a month in every month. Let me take a sip of this coffee. Let's calculate that and see what you get. If you put your money in the bank after 10 years at 10%, you'd get an end balance of $251,000, $252,000, $251,738.71. Your total contributions would have been $120,000. So your total interest is $111,000 over a period of 10 years, just leaving it in the bank. But now imagine you put this into shares, into the stocks. Now, stocks are renowned for giving you more than 20%, sometimes 25% on average, especially on the US 500 stocks. So let's just use 20%. Which is double, because effectively that's where we stand with it. Now I'm going to calculate it at a 20% rate. Look at that. $462,954 in 10 years. Let's make that 20 years. Now we're waiting for 20 years. Let me put it at a bank rate of 10%. So if we had 10% in the bank over 20 years at a $20,000 initial deposit at a $1,000 monthly contribution, you would have $852,000 on today's terms at the end of the investment, with only a contribution of $240,000. Your total interest is $592,000. That's just by putting $1,000 a month away every single month. I'm using this figure. You can use any figure you like. I just use this calculator.net. It's quite nice. It's free. Enjoy it, guys. Do your calculations. Let's say you get a proper return rate from your shares of 20%, which is expected. You should get more, actually, much more. But I'm being very conservative here. And let's calculate that. So now you've invested in shares instead of the bank. You've done it for 20 years at a return of around 20%. You'll probably make 25-30% on shares, but let's just leave it at 20 annually. 20 years, today's terms, you will have $3,205,608 with a total contribution amount of $240,000. Does that sound like something that would interest you? Now, imagine 30 years. Imagine 30 years with that kind of contribution. Now, just bear in mind, guys, that this $1,000 a month, you will increase over time because inflation goes up at 10% per annum. Increase your contribution by 10% per annum. Add some more. So I'm just using an average of 1,000. You might start at 500 and end on 3,000 and probably achieve a similar result. I'm just giving you this information, but do a calculation. If you put this in for 30 years at 20% per year, which is quite easy to achieve on the stock market, at $1,000 a month contribution on average, at the end of the period, you will have $20,187,401 with a total contribution amount of $360,000. Is that something you could live with? That's why I'm telling you now, at your younger age, I don't know if you're my age, then maybe you've only got 10 years or 15 years. But if you are a young lad, do yourself a favor and look at this. Just look at that. And you know you're going to make more than 20%, and you're going to have an additional contribution. You're going to add more than that. You're going to be so well off in 30 years' time. It's an absolute joke. And this money will also pay you dividends, and you'll have all this money at the end of the period. It's such an amazing pension. It's ridiculous. We'll talk about the fact that you'll need to trade along the way because you'll need an income along the way. But if you can afford to give contributions like this for 30 years, this is where you're going to end up. How do you invest? Well, you can go to Yahoo. If you've got an investment company that you invest with, then you can use Yahoo for your research. It's so easy. They give you all this. Yahoo Finance gives you all the information you could possibly dream of. So you just need an investment platform where you can invest your money. That's all you need. Then they'll give you this information. You can click on, for example, you can click on NVIDIA. And then effectively, you're going to come out here. I just don't want to waste your time clicking on it. And you can say, I want this year to date. I want it over a period of 1 year. And I can see where they're going and what they're doing and what's going to happen next. What you also get is a 1-year target estimate of where they're estimated to turn up. That's where they take a whole bunch of traders. They get an average of what they believe the market's going to become, and they measure it from there. You get a forward dividend yield, which is how many dividends you're going to get. And this one's not so good, 0.03%, but it's a dividend yield. Your earnings date, when you're going to get the earnings, when you're going to get the ex-dividend. Earnings per share, the amount of earnings you're going to make per share. Your price to earnings ratio. Look, it's a little bit high. 53 is a little bit high. This is a forward price to earnings ratio, which means at the end of the day, this should be around 15 to 20. And anything below that is good. Anything above that, it's a bit expensive. That's how you determine the expense of a share. But at the next earnings, that could change and it could come right down. That said, what we're looking at is forward earnings and what we're going to get in the future. And then they give you all the volume and market cap and previous closes and bid and ask and that sort of thing as well. So when you buy this, you buy it along here and it just keeps on ticking along. It goes up, it goes down, it goes up, it goes down. And a lot of people will tell you, but you can make your money on the downs and the highs and the downs and the highs and buying and selling. But that's trading, and you're doing that anyway. This is investing. Just buy it, leave it. If you bought it there, look where it is now. It's already more than double the price if you'd bought it there, and look where it is now. So you'd be pretty well off, and you'd most likely be pretty happy with your investment. This is 1 year, guys. 1 year. This is a great investment, but 1 year. If you want to look at charts, Yahoo's got that for you as well. Just go to the advanced chart. Here's your advanced chart. This is Coke. There's a line chart of what it's doing, going up, going down, whatever. You've got indicators and everything you can use on this thing. If you want to put candles on, you can put candles on and see where you stand. You can make it bigger and smaller as well, just like on our TradingView trading charts and all the rest of it. And what this does is it just gives you an indication of where you want to be. And if you want to put indicators like a 50-day and a 200-day moving average on, you can. There's no problem with that. You can put a moving average of, say, 50. Yeah, there's a 50-day moving average. Let's make it a slightly different color so it doesn't look too bad. You can put another moving average on of, say, 200-day moving average. Maybe change the color a little bit, make it blue. I don't know. And there's your 200-day moving average. And in this particular case, it's kind of showing you that it's your 200-day. Okay, which one was which? Okay, that's your 50. So your 50-day moving average has actually crossed back through the 200-day. Now, that's your 50-day moving average has crossed through the 200-day moving average. So it's kind of a death cross. It's not looking good for Coke. I must admit, it's one of my investments, but I'm not going to sell it. I'm not going to get out of it. I'm just going to keep it. I'm not worried about it. It's done that a number of times in the past, and so what, okay? So, if you've bought it down here, who cares? It's going up and it's going in that direction. But you can put these in if you want to. and you can have a look as well. But that's how you do your investments, guys. That's how you invest in the markets, and if you want to use charts, you can, but I don't even bother looking at the charts most of the time. Most of the time, I just look at this. I just check where the thing is and what everybody thinks of the share, and is it a good one, because I think it's good. I mean, there's a whole bunch of analysis tools that you can use. Even here, there's analysis, analyst recommendations, revenue, earnings per share. It's all here, guys. It's all here for you. Earnings estimate, revenue estimate. Everything's here for you, guys. There's news on the share. There's charts, conversion statistics, historical data. Our financials are here for you, and it's all available for free. You don't even have to pay for this information. It's totally free. So guys, investing is easy. And the psychology of investing is just choosing the right share and totally forgetting about it. The psychology behind investing is being able to walk away and totally forget that you've got the investment and just keep putting money back into it, so that in 30 years' time, you've got a total that looks something like that from all your investments over the years. That's what's going to make you rich at the end of the day, not this quick buck here and there. The quick buck here, the trading that I show you on a regular basis every week, that's to keep you going, guys. That's to make that $1,000 to pay into the investment. That's to keep you healthy for the next 30 years. At the end of the 30 years, you're looking at the big total. That's what you're looking for. You see, that's the calculator. That's how you make money over time. The thing is, what you have to understand is that if you trade, you need charts. You need to know exactly where to put it. It's a very short-term way of making money trading. So when we trade price action and we use our trading price action systems, we tend to want to make money in 5 minutes, in 4 hours, in 1 hour, in a day, maximum probably a week. Some of you will take a month or longer, but not much longer than that. If you find a trader that's taking a year to get out of a trade, that's insane. Okay, that doesn't work. That doesn't happen. But investing, completely different. When you invest, you pick shares. And the best way to invest, guys, I know you can invest in exchange-traded funds. You can invest in commodities. You can invest in whatever you like. But you can't really invest in Forex, because that's not really long-term. Commodities are kind of cyclical. They go up and down. For example, if you had invested in gold 99 years ago, if you can get that old or become that old, which doubtful, then you would have made a rather large sum of money, but not as much as if you'd invested in the US 500. So if you'd invested in gold, you would have had a good return. If you'd invested in the US 500, for example, an index, you would have made millions if you'd say invested $10,000. There is a massive difference between the two, because your returns on shares on an annual basis are a lot higher than what you think. You see, a lot of people will look at returns on shares or putting money in a savings account. So you put money in one of these investment retirement annuity accounts or whatever, and they promise you that you'll get 12% or 14% or 10% back on your money. But it's not guaranteed, number one. And number two, that is not a lot. You can actually achieve more than 20% on the stock market on average if you look at it over a long period of time. So don't discount investing in shares. Now, here's the thing that we always overlook when you do the share investment. All I've shown you on that little calculator was if you take the investment, you invest in 5 or 10 shares, you put that money away every month, and you wait 10, 20, 30 years, and this is the money you'll get back from those shares. This is the investment. This is the growth that you should achieve from those shares based on today's value, by the way. Now, imagine this. On top of all that money, there'll be a whole bunch of those shares that you purchased that will actually have paid you dividends as well. A dividend amount every single year, an additional between 2% and 8% per annum, depending on the share, which would come back to you every single year. People overlook that. They tend to forget that happens as well. And if you added that on top of that calculation, it probably would become quite insane. So keep that in mind as well. Now, how do you invest? How do you invest in shares, and what's the best way to go about it? Well, number one, guys, we do not leverage when we're investing. There's no leverage. Coffee with Rob, so we're having coffee. So when we are investing, there's no leverage. We don't take 100 to 1 leverage amounts and funded accounts and all that sort of thing. When you're investing, it's 1-to-1. You have $10, you're investing $10. If you have $1 million, you're investing $1 million. You're not getting $100,000 for $100. That's not how it works. Because That's how you lose money. That's trading at the end of the day. Investing is a different ballgame. With investing, you're looking at a scenario where you are actually going to be putting money in and leaving it there forever. I call it set and forget. You're setting and forgetting. So the best way to invest is to choose shares as you go. I wouldn't recommend having more than 20, but the actual perfect amount is if you've got 10. Some people have 5, some people have 3. Doesn't matter. When you start out, pick one. The way to pick it is the top companies. Look for the companies in the world that are doing well. Because the thing in the stock market you have to understand is this. If something looks expensive, that's a good buy because it means it's doing well. And if something looks cheap, that's a bad buy because it means it's doing bad. Doesn't mean that it's a good buy. But you can do research. You can go and have a look at companies and check their PE ratios, their price to earnings ratios, their earnings yields, their dividend yields, and that sort of thing. You can have a look at their balance statements, and you can decide for yourself whether you think this is going to be a good company or not. Now, investing is different from trading. Trading, we're using charts and we're seeing what other people are doing. Investing, you're looking at a high probability that you're going to make a profit in the far future. So you're looking for a company that's really got the possibility of staying there, doing well and staying strong. So you want the company to have a good management team. You want the company to have good financials. You want the company to have a good background. But a way to look at it as well is if you are trading in a company that's within your country, but even if it's not in your country, for example, I'll invest in Amazon and I'm looking at a company that's online, that's growing immensely fast, and I can see lots of potential for the company. You can see it from the outside. It's not difficult to spot it. Companies like Coca-Cola, why would they be a bad company? It looks good. They're still selling Coca-Cola and lots of it. There's a lot of controversy surrounding some of the alcohol companies, breweries, things like that in the world. But you can look at companies and say, well, they're going to tell them to put a little label on their bottles, but they did that with cigarettes and that didn't change anything. And their price comes down a little bit. Nail in and buy, because alcohol companies always make money. It's one of those things. Until such time as they ban alcohol completely, which I doubt they ever will now, we're looking good. That's what you got to look out for, though, is if you are invested in a brewery and suddenly somewhere in the world there's a hint of we're going to ban alcohol completely, then you've got to sell it because then you know the trouble's coming. If you're looking at a company within your country and you shop there, it's a retailer or a bank, whatever, let's say retailer, and you can see the growth, you can see what they're doing with the stores, you can see there's loads of customers building up there and it's getting more and more popular and so on and so on and so on, you can think for yourself, that is possibly a good buy. Go and have a look at their financials, go and have a look at their price to earnings yields, that sort of thing. See where they're going, see what the price is like, and just buy, set and forget. Don't look at the charts, guys. Don't worry about it. You can look at the chart, and if you want to buy and be a little bit technical about it and say, well, if the 50-day moving average is above the 200-day moving average, then I'll buy. Okay, because it's a golden cross. And if it's below the 200-day moving average, then I'll sell because it's a death cross. You can work like that if you want to. You can trade your investments if you really want to. But the way I look at an investment is just keep on feeding it, forget about it, and come back in 30 years. I showed you why. I showed you what will happen if you just keep on feeding an investment, because you see what happens. I don't even look, if you're trading like we are, you're looking at your charts all day, every day, checking back. If there's a day where you haven't looked at your charts, it's probably a holiday or a Sunday. And even then, you probably had a look to see what you're going to trade tomorrow. I rest my case. I mean, that you for sure. So with investing, you'll be lucky if I look at my portfolio once or twice a month just to see how it's doing. Really, it's not that important. It's going on by itself and it's growing. And somewhere down the line, it's going to pay me back an immense, huge sum of money. And that's what investing's all about. If you want to trade your investments, like I say, the best way to do it would be to use the moving average crossover over the 200-day moving average and just watch it that way. And if you want to trade it with charts, you can trade it on price action. You can look at price action and say, I'll take my entry from this point when it gets to the support, and then I'll buy, and then it'll just leave it there forever. If you don't want to buy it at too high a price or when it's too expensive or whatever the case. But the important thing to remember when you are investing, and this is really important, guys, so important. Number one, no stop loss. I mean, This is almost like dollar cost averaging. Investing, you buy, you set, and forget. The only time you stop out of an investment is if you can clearly see that this company is done for and there's some fundamental information that's causing it to maybe go down. That's the only time. Okay. Number 2, add to your investment on a regular basis, at least once a month, every single month. And if you can, any spare pennies that you have, throw it in there. My third rule is never penny stocks. Don't do penny stocks. Penny stocks for me are a risk. It's a gamble. And this is not gambling that you're doing here. This is investing. When you're investing, pick what we call blue chip companies, top companies, good companies. Pick name brands. Pick companies that you know are going to be there for a long time. And they're going to make you money over a long time. The guys that are picking penny stocks, the guys that are going for the new stocks and the cheap stocks and the venture, let's say venture capital, that sort of thing, they're gambling on the fact that 1 out of every 10 that they choose will be a huge success. You're not gambling that way. You're gambling that every single company that you own will grow over the next 10, 20, or 30 years. That's what you're gambling on. Because at the end of that period, like for example myself, I've been trading for 30 years. But most of my income will come from the investments because 30 years down the line, the investments have got all the money. The investments are making all the money. They're so well off, so you don't need to actually worry about it anymore. You're not desperate to make the trading work for you because the investments are working for you. The difficulty that you have as a human being is that you need to work for those 30 years. You need to make an income for those 30 years. So whatever's going into the investments is very much like a pension. It's very much like sideline money because your real money is coming from your trading. Your daily money is probably coming from your trading. And that's the balance that you have to find. The balance that you have to find between trading and investing. The balance is easy. The balance is my investments are for the future. My trading is for today. You'll get to a point, a crossover point, where the investments are paying you enough, and then you don't stop trading because you've been trading for so long, so you just carry on trading, and trading's addictive, and so on and so on. That's just life. That's how it goes. So I just thought I'd give you guys a little bit more insight as to why investment trading is good, why investing is good, why you should be investing. And the psychology behind it is not as complicated as trading. So the psychology behind trading, as you know, is picking your stop loss, having a strategy and all the rest of it. Look, you've got to have a strategy for your investments, but the psychology of investing is so much easier. You know, if you invest in something, it's just straightforward. You don't have to worry about it. You don't have to stress about stop losses. You don't have to stress about when you're getting the profit. You just put the money in, forget about it, walk away, and you come back one day. If you give your money to a bank and they give you interest on the money, you're not going to make anywhere near as much as you would make if you invested it in the shares and left it there for 30 years. So I hope that helps you guys. I hope that little investing thing will put you in good stead and give you hope for the future. The end of the day, I know you all want to make instant money. I know you all want to be traders and make money today. And that's what I show you in all my videos. If you go back to all my videos, I'll show you how to trade. I'll show you how to trade with price action, and you'll make money that way as well. But today's video was about investing. Thanks for watching, guys. Until the next video, cheers, ciao, and bye.